I'm the first to admit hedge accounting is boring. It's meant to be. Hedging is all about reducing volatility, mitigating risks that an entity does not want to be exposed to. For example, foreign currency risk on sales or commodity risks on purchases. Hedge accounting is meant to match the gains or losses on the derivative financial instruments used as hedging instruments with the income statement impact of the hedged item. Today, IFRS rules for hedge accounting are very rigid, and many times economically valid relationships can't achieve hedge accounting. The IASB has set out to change this and convert a historically rules-based set of standards into a more flexible and simple principles-based approach. If your company applies hedge accounting today, you'll have suffered through hedge effectiveness testing. The existing hedge accounting rules require that you test and demonstrate hedge effectiveness each quarter. If you fall outside a specified range, the hedge relationship fails. Sometimes it's not possible to perfectly offset risk at a reasonable cost, so companies use a proxy, which is still economically valid, but from an accounting perspective would not fall within that range. The intent of the new standards is to allow a company to designate hedging relationships that are economically valid and fall in line with the company's risk management strategy. It recognizes that you can have a less perfect relationship, but it's still reasonable. Another key element of the proposed standard is the ability to hedge components of non-financial items. Under existing rules, if you were buying a manufacturing component with a high aluminum content, even if the invoice price was indexed to aluminum, it was generally not possible to hedge. Now, the new standard would allow hedging of these non-financial components where you can demonstrate a clear relationship with pricing. We do expect that this will significantly increase the application of hedge accounting in manufacturing, transportation, and natural resource companies. We expect that the final hedging standard will be published shortly. Although the mandatory effective date of IFRS 9 has been deferred indefinitely, we do expect the standard would be available for early adoption. For existing hedging relationships, early adoption would save time with respect to effectiveness testing and decrease volatility if you're using options to hedge. If you do not currently apply hedge accounting but use derivatives to economically hedge, you should consider whether to designate these in a hedging relationship and decrease your income statement volatility. Even if you don't economically hedge today, you might want to use this as an opportunity to reevaluate the risks that your entity is exposed to and consider whether it makes sense to hedge. Although hedge accounting is boring, it's a good kind of boring if you like less volatile earnings. We'd love to talk to you further about hedging, so please don't hesitate to contact us.